Britain was promised a reset. Freedom from bureaucracy, stronger trade, a faster, more competitive economy. Years later, the numbers tell a different story. Growth lags behind peers. Productivity remains weak. Living standards stagnate. And yet, there was no single collapse, no dramatic crash to point to. So the mystery isn't whether Brexit hurt the UK's economy. It's why the damage looks permanent, and why recovery never truly arrived. To understand this, we have to look at what Britain's economy actually was before Brexit. For decades, the UK occupied a unique position. It wasn't just a European economy, it was a bridge. London acted as Europe's financial hub. Capital moved through the city. Services flowed across borders with minimal friction. Manufacturing mattered less. Finance, law, insurance, and data mattered more. This system depended on access. Access to European markets, access to talent, access to regulatory alignment. During the rise phase, this model worked extraordinarily well. Financial services expanded. The pound remained strong. But beneath that success was a quiet dependency. Britain outsourced stability to integration. As long as access remained frictionless, the system held. Brexit broke that assumption. The breaking point didn't come on referendum night. Markets adjusted, the pound fell, but the system didn't collapse. Instead, the damage unfolded slowly. Trade frictions increased. Services lost passporting rights. Companies restructured, not loudly but strategically. Banks moved staff. Firms duplicated operations in Europe. Investment decisions were delayed or redirected. None of this looked like a crisis. That's why it was more dangerous. The fallout emerged through opportunity cost. The UK didn't fall behind because it shrank. It fell behind because others moved forward. While the US invested heavily in technology and capital markets. While the EU deepened internal integration, Britain stalled. Exports underperformed. Productivity flatlined. Business investment weakened. The economy kept functioning but lost momentum. Policy responses tried to fill the gap. Trade deals were announced. Regulatory freedom was promised. Fiscal stimulus came and went. But these fixes misunderstood the problem. Britain didn't lose rules. It lost scale. Access to a large nearby market can't be replaced by distant agreements. Services trade doesn't move like goods. Finance doesn't relocate easily, but it does relocate permanently. Once infrastructure and talent shift, they rarely return. Modern data reflects the pattern. The UK's trade intensity declined. Foreign direct investment lagged. Productivity growth trailed comparable economies. At the same time, costs rose. Supply chains became less efficient. Labor shortages emerged. Inflation hit harder. The system absorbed the shock but couldn't reverse it. History offers parallels. Countries that decouple from major markets rarely collapse. They drift. Growth becomes weaker but stable. Policy becomes reactive. Living standards stagnate quietly. Britain's challenge isn't that Brexit caused immediate harm. It's that Brexit removed a growth multiplier. The economy now runs without a tailwind. Failed fixes followed a familiar pattern. Short-term tax cuts without long-term investment. Deregulation without scale. Political promises without institutional alignment. Each fix treated symptoms. None restored the underlying advantage. The UK still has strengths. Deep capital markets. Strong universities. Global connections. But strengths need amplification. And amplification requires access, confidence, and scale. The repeating pattern is clear. When economies lose integration, they lose momentum. When investment hesitates, productivity follows. When productivity stalls, living standards suffer. This is why recovery feels absent, not because nothing improved, but because the baseline shifted lower. 3 conclusions stand out. First, economic damage doesn't need collapse to be permanent. Slow losses compound invisibly. Second, services economies depend more on access than autonomy. Regulatory freedom means little without market depth. Third, reversing structural shifts is harder than creating them. Once capital adapts, it doesn't wait. The open question isn't whether the UK can grow again. It's whether growth will ever return to what it might have been. Because the most expensive economic decisions aren't always the loudest ones. They're the ones that quietly change the path forward. If you want to understand how political choices reshape economies over time, not through shock but through drift, subscribe to the channel. Because the biggest economic stories aren't about what breaks. They're about what never comes back.